In this video, we shall be learning about the types of investors and hedging and the advantages of hedging. So let's continue. So types of investors in the market. So there may be various types of investors which are there in our financial market who would like to make investment and earn returns. So basically, the first one is individual investors. Individual investors are like individuals uh, like us, where we can invest from the income that we earn, so that in future there is a amount of fund available for after retirement or for any other objective. So individuals can take part in various instruments, not all, but there are certain instruments where only institutional investors can take part. Then there are retail investors. So retail investors and individual investors are the same. That is, retail means it is the amount of transaction which is made, which is smaller in comparison to the larger ones. Then we have high net worth individuals, HNI. So high net worth individual is somewhat different from individual investors, whereby in HNI the amount of investment would be made by individual only, but the amount of investment would be very large as compared to retail or individual investors. Then we have partnership firms. Obviously, these partnership firms, if they are earning profit, they would be investing that amount. From the profit, they would be investing some place whereby they can get better returns. Then companies, obviously, they make investments to, from one company to another company and from various other instruments as well. Then we have societies and trusts. The income that the societies and trusts earn, they generate these incomes and some invest in proper places. Mutual funds, we all know that mutual funds, because it's a place where small individual investors make investment and they on the part pool that amount and invest somewhere different, or some places where individual investors cannot reach. Then we have financial institutions like banks and other insurance companies. These companies invest in securities issued by the government of India, RBI, then even other securities as well, whereby it helps in the regulation of liquidity in the country. Then we have foreign institutional investors, FIIs. These are also a type of investors where the investment is made by foreign institutions in our country. So there are also various regulations associated with it. But these are this is a big picture or the overview of what are the various types of investors in our country or in our financial market. Next, we move on to hedging. So word itself, we must have come across this word, hedging. So hedge is an investment that protects your finances from a risky situation. So it's in financial market, it is basically you're trying to purchase or trying to invest in an asset which helps you reduce the loss. That it limits it. It's a process through which you limit the amount of loss that would arise in a investment. So hedging in finance is a risk management strategy that deals with reducing and eliminating the risk of uncertainties. So strategy that deals with reducing and eliminating the risk of uncertainty. So in case there is certain uncertainty that in other instruments, but in by hedging you can overtake or you can overcome that particular issue. So it helps restrict losses that may arise due to unknown fluctuations in the price of the investment. So you see there you may take the advantage of various prices in different places. Like suppose the price in a particular market is different from the price in another market. So you take the advantage that in such a way you take a role or you play such a role that whereby you do not face the uncertainties associated with the fluctuation. So it's a standard practice followed by investors in the stock market to safeguard their investment from losses. So this is also done in the following areas. So commodities, it includes agricultural products, energy products, metals, etc. The risk associated with these is known as commodity risk. So in order to hedge It can be included in commodity hedging as well. Then securities, it includes investment in shares, equities, indices. The risk associated with these are known as equity risk or securities risk. So hedging can be done in commodities, in securities, and currencies especially. It includes foreign currencies. There are various types of risk associated with it, like currency risk, volatility risk, etc. So in currency also there may be fluctuations, so you can avoid it by making an hedge. So interest rate, it includes lending and borrowing rates. So the risks associated with these are known as interest rate risks. So hedging also comes in interest rates. Weather, like I have already discussed in my earlier videos, how weather derivatives are available in the country. So it is also one of the areas where hedging is possible. So these are some of the places or the avenues where hedging can be done. Lastly, the advantages. So it can be used for locking profit. So obviously, when you're trying to remove the uncertainties, you're obviously locking the profit. Enables traders to survive hard market periods. So in case the traders foresee that there may be certain situation whereby an uncertain market may rise, so that can be avoided. It limits losses to a greater extent. By that is what by locking profit, the losses reduces. Facilitates investors to invest in various asset classes, therefore increasing liquidity. Like I was explained earlier, only in this particular slide, various assets are there where hedging can take place. It also helps in saving time as long as a long-term trader is not required to monitor and adjust his portfolio with daily market volatility. So if you are very busy, if you're having a 9 to 5 job, then it's not possible to look at the market daily. So hedging helps in that particular case. It offers flexible price mechanism as it requires lower margin outlay. Lower margin outlay means the minimum amount that is invested may be very less. It gives trader protection against commodity price changes, inflation, currency exchange rate. That is it helps in the process of earning profits or earning better returns. In hedging, using options provides traders an opportunity to practice complex options trading strategies to maximize return. So when you will be learning in the upcoming classes, when you learn how to do the technical analysis, the fundamental analysis, then you learn how the traders make an analysis of the market. So option is such a way whereby the trading can take place. So there are various ways through option trading can be done. So advanced option strategies can be taken or be made. So it helps in increasing liquidity in the financial market. Lastly, so injecting liquidity is also one of the ways through which it helps the financial market. So that is all about hedging and types of investors. And with this, we come to the end of the unit one of security analysis and portfolio management.